Hi guys, I'm Chip.
And I'm Tommy.
We're the interns here at Dorsey Wright. We just wanted to find a few basic finance and market terms for you guys today.
Alright, first of all, we're going to go over what a market order is. And when you're placing an order for an investment, a market order will do it for whatever the current price is going for. So it'll do it automatically during the day.
So the thing that's going to determine the price on a market order is the bid-offer spread. And that's essentially the prices that are being offered by market makers. So these are people who are always willing to buy or sell this given security for a certain price. That's how they make their money. So the difference between the bid and the offer is how much the market makers are willing to pay at any time versus how much they're willing to sell it for at any time. And that's how they make their money, and that's how that's why there's a difference between the bid and the offer. And that's what a lot of times people refer to as the spread.
Also, when you're making it an investment, you can either go long, you can go short. Going long is you're buying the investment, so you're hoping that the price of it will go up. Going short is just the opposite, so you're anticipating that the price of the investment will go down. And you can take advantage of both of these, but a majority of the time most people just end up going long.
And when you're going short, you're actually borrowing the shares or the security from someone else, selling it, waiting for it to decline in price, and then buying it back and giving the shares back to whoever you borrowed them from, therefore keeping the difference in the price. So that's how people go make money off of falling markets.
And once you are in a position that you've done the market order and you've executed the trade, you can then put a trailing stop or a stop loss or a stop limit on your order. So that way you can, a stop limit with a trailing stop is something, so you can go set a price. So say the stock is trading at $100 and you bought in at 90, and you want to always gain at least a little bit of profit, so you could go in and put a trailing stop for $5 per share, so you would automatically gain that $5 per share and you wouldn't lose it. And what that does is if the price ever hits 95 or goes down to the $5 spread, you will automatically be sold out of the position. And if that price goes up to 105, that trailing stop will move up to 100. So every time the stock moves up, the trailing stop follows it. So it's just a way for you not to have to keep looking after your investment all day long and making sure you get the most profit. You can just set that and it'll do it automatically for you.
So if you don't have a trailing stop, you just have a regular stop in. A lot of times you can do that to either secure profits that you've already made on a position or prevent any drawdowns or losses on a position. But if you have a stop in at a certain price, let's say you have a stock you own a stock that's trading at 75, you put a stop at 70, that doesn't mean if the stock trades at 70, you're going to sell it at 70. That means that if the market moves to 70, you will get a market order executed at that time. So not necessarily at that price, but at that time. So that's what a stop order is.
And one thing we do to determine which one we want to go into is we use relative strength. It's a big thing here at Dorsey Wright. So we can put our picks into a matrix, or we can compare one against one, and what that essentially does is it puts all of them into an arm wrestling match and it decides which one's better, which one's worse, and the system on the computer will actually tell us which one's better, and then we can just go in and execute the trade and make some money.
Thanks for watching.